Two friends, same salary, same savings. Liam drops his cash into a rental property. Chris throws his into index funds. Fast forward 20 years, and one of them is significantly wealthier. The question is, which one? And more importantly, why didn't the other one see it coming? Here's the setup. Liam and Chris each have $40,000 sitting in their savings accounts. They both pull in $48,000 a year. Same age, same city, same starting line. The fork in the road? How they invest that 40 grand. Liam goes all in on real estate. He puts down 20% on a $200,000 condo, a solid 2-bedroom unit in a neighborhood that's quietly improving. His 30-year mortgage at 7% interest costs him $1,065 every month. He locks in a tenant at $1,600 monthly. Do the quick math, and that's a $535 monthly profit, at least on the surface. Liam's feeling pretty smart right now. Chris takes a different route. He dumps that same $40,000 into a broad market index fund. No tenants, no showings, no late night repair calls. He automates $400 a month into the same fund and basically forgets it exists. When friends ask what he's investing in, he shrugs and says, just index funds. The conversation usually ends there. Day one looks wildly different for both of them. Liam's got keys to a property, a lease agreement, and something tangible to talk about. Chris has a PDF statement and a portfolio balance. If you're measuring by excitement, Liam wins in a landslide. But excitement and wealth aren't the same currency. The first couple of years feel incredible for Liam. That rent check hits his account like clockwork. Every time he drives past the condo, there's a little voice reminding him, you own this. Tax season feels better too. Mortgage interest deductions, depreciation write-offs, the whole package. Equity's building. Nearby properties are appreciating. Everything points to a brilliant move. Chris's experience? Boring. He logs into his account maybe 4 times a year. Year 1, that $40,000 climbs to around $48,000. Year 2, it's sitting near $56,000. There's no drama, no physical proof, no dinner party stories. Just slow, quiet growth on a screen. Socially, Liam's crushing it. People ask about the rental. They want details. Chris doesn't get asked about anything. That social validation gap makes Liam feel like he's miles ahead. But let's actually run the numbers at the 3-year mark. Liam's collected $57,600 in total rent. His mortgage payments over that time? About $38,340. Subtract one from the other, and you're looking at $19,260 in gross profit. Sounds phenomenal until reality walks in. Annual property taxes eat up $2,400. Insurance takes another $1,200. Then comes the fun stuff. A busted water heater, $950. Roof leak repair, $2,200. 1 month of vacancy between tenants. There goes $1,600 in lost rent, plus another $500 for cleaning and marketing the unit. And because Liam's managing this himself to avoid paying someone else, he's fielding tenant texts at 11 p.m., meeting contractors on Saturday mornings, and dealing with move-out inspections during lunch breaks. When you add it all up, Liam's actual profit after 3 years lands somewhere between $3,000 and $5,000, a far cry from that $19,260 he calculated on day one. And we haven't even factored in his time, which if you assigned an hourly rate, would probably wipe out the rest. Chris, meanwhile, he's sitting on roughly $68,000. That's his original $40,000, plus $14,400 in contributions, compounded at around 10% annually. Total hours spent managing it? 0. Stressful phone calls? 0. Weekend emergencies? 0. Now here's where Liam does have a legitimate edge. Leverage. His $200,000 property has appreciated at maybe 3.5% a year. It's now worth somewhere between $222,000 and $230,000. His equity, what he actually owns after subtracting the mortgage, sits around $48,000 to $56,000. That's wealth created partially with borrowed money, something Chris can't replicate in the stock market without getting into margin trading, which comes with its own nightmares. So let's talk about what Liam's rent check really represents. Everyone loves talking about rental income. It's sexy, it's measurable, it shows up monthly. What doesn't show up in casual conversation is the long list of expenses chipping away at it. Vacancy is inevitable. Even great landlords lose about a month of rent per year on average. That's $1,600 vanishing, while the mortgage bill stays exactly the same. Plus, the time and cost to turn the unit over, clean it, list it, and vet new applicants. Maintenance isn't optional. The general guideline is 1 to 2% of the property's value annually. For a $200,000 condo, that's $2,000 to $4,000 a year. Some years you get lucky with minor fixes. Other years the HVAC system dies in the middle of summer, and you're writing a $6,000 check because your tenant legally deserves air conditioning. Then there are the big ticket items you know are coming, but can never quite predict when. Roofs, furnaces, water heaters. These don't last forever. When they go in expensive chunks, anywhere from $4,000 to $12,000, depending on what breaks. If you're not setting money aside every single month for this, you're not planning ahead. You're gambling on timing. Property management, whether you hire it out or do it yourself, costs something. Hiring a company means losing 8 to 10% of your rent immediately, around $130 to $160 monthly. Doing it yourself means you're on call 24/7 for free. There's no escaping this cost. It's either financial or personal. And then there's the risk that keeps seasoned landlords up at night. Problem tenants. Someone who stops paying, understands tenant rights better than you do, and knows exactly how long they can drag out an eviction. That situation can cost you 3 to 6 months of lost rent, plus legal fees. One bad tenant can erase an entire year's profit, sometimes more. None of these costs appear in that initial $535 monthly profit calculation, but they absolutely show up in reality. By year 5, Liam's deep into the landlord experience. He's dealt with 3 different tenants. The roof needed replacing, $7,200. Emergency plumbing issue, $1,100. The unit sat empty for 6 weeks at one point. He's raised the rent to $1,750 to keep up with the market, but property taxes and insurance premiums have climbed too. When he actually calculates his cash-on-cash return, accounting for everything he's spent and earned, it's hovering around 4 to 5%. Not terrible, but nowhere near the 18% he casually mentioned to friends in year 1. Chris? Still doing absolutely nothing. By year 7, his portfolio has grown to somewhere between $120,000 and $135,000, fueled by those steady $400 monthly contributions. He didn't research individual companies. He didn't try to predict market movements. He just stayed invested. And now the compound growth is visibly accelerating. The returns he's earning on previous returns are generating more wealth annually than his new contributions are adding. Here's the pattern forming. Liam's wealth is growing, but slowly, and only after factoring in constant effort and unpredictable expenses. Chris's wealth is growing on a curve, slow and underwhelming early on, then faster and faster as time passes. Compounding is unimpressive for the first 5 years and absolutely explosive for the next 15. Jump ahead to year 10. Liam's property is now worth approximately $280,000 to $295,000. His remaining mortgage balance sits around $145,000. That puts his total equity between $135,000 and $150,000. Over the full decade, after accounting for taxes, insurance, repairs, vacancies, and capital expenditures, Liam's total out-of-pocket spending beyond that original down payment falls somewhere between $16,000 and $28,000. Chris's portfolio, still getting those $400 monthly deposits, now sits at roughly $220,000 to $240,000. His total contributions over 10 years, $88,000. Everything above that is compound growth. And he spent exactly 0 weekends coordinating with contractors or dealing with tenant complaints. At the 10-year mark, they're surprisingly close in total wealth. Liam might have a slight edge thanks to leverage. But consider the full picture. Liam spent hundreds of hours managing the property, took on significant debt, and concentrated all his risk in a single asset in one specific neighborhood. Chris diversified across thousands of companies globally and never lost sleep over a broken appliance. This is the point where their paths completely diverge. By year 20, Liam's property is valued somewhere between $380,000 and $430,000. His mortgage is either fully paid off or nearly there. His total equity sits between $350,000 and $430,000. Over those 2 decades, he's collected rent consistently. But after 20 years of maintenance, property taxes, insurance premiums, occasional vacancies, and at least 1 major renovation, his net profit from cash flow, the actual money he pocketed above all expenses, is probably somewhere between $30,000 and $65,000. Maybe higher in a hot market, maybe lower in a flat one. Chris's portfolio, with those same $400 monthly contributions and an average 10% annual return, it's now sitting at approximately $520,000 to $580,000. His total contributions over 20 years come to $136,000. Everything beyond that, over $400,000, is pure compound growth. No debt, no tenants, no emergency phone calls about burst pipes in February. Chris is now ahead by somewhere between $90,000 and $150,000. And the way they each built that wealth couldn't be more different. Liam actively worked for every dollar. Chris passively waited, while compound interest did the heavy lifting. Liam dealt with stress, concentration risk, and illiquidity. Chris dealt with market volatility, but maintained liquidity and personal freedom. Here's where it gets even more interesting. If Chris had increased his monthly contribution by just $200, bringing it to $600 a month, his 20-year portfolio would jump to roughly $720,000 to $800,000. That's the multiplier effect of compounding. In the stock market, scaling your contributions amplifies your results exponentially. In real estate, scaling usually means acquiring another property, which means another mortgage, another set of tenants, and doubling your responsibilities. Now, let's be completely fair here. If I only highlighted real estate's downsides, I'd be doing exactly what every index fund evangelist does. Stocks come with serious risks that people conveniently skip over. Market volatility is genuinely brutal. In 2008, the market dropped 37%. In March 2020, it plunged 34% in a single month. Imagine Chris with $130,000 in his portfolio, watching it crater to $85,000 in a matter of weeks. That's not just a number on a screen. That's psychologically devastating. And the data consistently shows that most individual investors panic sell during crashes and buy back in after the recovery, permanently locking in losses at the worst possible moment. There's also zero cash flow. Unlike a rental property, index funds don't send you a check you can use to cover bills. Sure, dividends exist, but on a total market fund, you're looking at maybe a 1.5% yield. On $130,000, that's about $160 a month. That's not replacing anyone's income. And there's no leverage. Chris used $40,000 to control $40,000 in assets. Liam used $40,000 to control $200,000 in assets. That 5-to-1 leverage is extraordinarily powerful when property values rise. And it's the main reason real estate consistently creates more millionaires than the stock market, according to most wealth surveys. Then there's the tax advantages. Real estate investors can deduct depreciation, the theoretical decline in their property's value, from their taxable income, even while the property is actually appreciating. That's a legal tax shelter stock investors simply don't have access to in the same way. Real estate absolutely wins in certain specific scenarios. If you're in a market where the rent-to-price ratio is healthy, meaning monthly rent hits at least 0.8 to 1% of the purchase price, the cash flow math works in your favor from day one. If you're willing to treat real estate like an actual business, carefully screening tenants, budgeting for capital expenditures, building operational systems, the returns can legitimately exceed stocks, especially when leverage is working in your favor. Strategies like house hacking, where you live in one unit of a multifamily property while renting out the others, can reduce your personal housing costs to nearly zero while building equity. The stock market simply can't offer that. And if you understand 1,031 exchanges, which allow you to defer capital gains taxes by rolling profits into another property, you can scale a real estate portfolio tax-free in ways stock investors can't replicate without retirement accounts. Real estate isn't a bad investment. It's just widely misunderstood. Liam and Chris both walked into their decisions convinced they were making the intelligent choice. Liam thought real estate was the time-tested wealth builder. Chris thought the stock market would quietly grow his money. But here's the thing. Neither of them sat down and fully calculated what their choice would cost in actual dollars, in hours spent, in stress levels, and in risk exposure over a 10 or 20-year timeline. The real mistake isn't choosing real estate, and it isn't choosing stocks. The real mistake is making the choice based on a YouTube video, a podcast clip, or something a relative mentioned at a family gathering.